Hello guys, this is Joe, the founder of Parabolic Financial. Today we're going to jump into one of my favorite inventions I have ever created, the Parabolic Wave Theory. The Parabolic Wave Theory is a technical indicator that helps predict changes in our new age stock market. 10 years ago, there was very few algorithms in the market. Today, over 80% of trades are made by algorithms. PWT, short for Parabolic Wave Theory, became a reality after the consolidation of 20 years of collected stock market data via our data analysis team and our systems. The data we collected over 20 years gave us more insight into how the market changed from how it reacted in the past to how it's currently reacting. PWT was designed to help traders and algorithms be able to understand short-term market trends easier. The basis behind Parabolic Wave Theory comes from how algorithms or market makers control the market. These different types of algorithms will determine how to move a stock, keep liquidity in the stock so the stock stays investable, and effectively maintain a higher level of price stability in investment. Based on our years of data research, we have determined that stocks have phases in each run, and that there are distinct cycles or waves that provide more insight into how the stock price fluctuates. PWT looks for 1 to 2 week short-term trends and determines whether the stock is in 1 or 4 main waves. These cycles are called wave 1, 2, 3, and 4. Within each of those cycles, the stock is categorized as bullish, bearish, convergence test, or overextended. Let's dive into these 1 to 2 week short-term trends and waves and outline some basic laws. The first wave always starts after a large short attack and a downtrend in the stock price. These can be seen by what I call stair-step shorting, or they can be spotted by plotting a downtrend with trend lines and utilizing the non-extended hour MACD dataset. Always start by locating that strong downtrend through the examples above and then mark wave 1. Each wave is not equivalent. Some waves can produce higher volatility, or in other terms, greater price action change. Statistically speaking, some equities have very few algorithms or investment firms interested in the stock. These particular equities tend to not have as tight liquidity, causing the stock to fluctuate very differently. Based on what you know about risk profiling from previous videos, this means that there is not an easy spot to set up an investment with higher probability of more reward than risk. Imagine owning a restaurant that is not well marketed. That restaurant will have inconsistent customers coming in. Because you do not have demand, then you have a higher chance of your food spoiling. The same thing can be visualized in the stock market. The less people that are interested in the stock creates an opportunity for traders or algorithms to get bored and drive the value down easier, because not many people want to own shares of that stock. Why is this relevant to PWT? There will be equities or investments that have weaker periods of interest, causing one of the waves to create less bullish volatility than other waves. Additionally, the same thing can be said in inverse for the bearish volatility. There will be other times when enough people bought the week before, so the demand increases, causing the next wave to have a higher probability of a bullish volatility. Let's summarize why each wave is not equivalent. Some waves in equities will be less stable, causing the equity to be more easily shorted or have traders lose interest quicker. At the same time, the faster and lower an equity drops, the more likely someone will start to believe that equity is now a good deal. This creates what we call flushing. Flushing is when a short is testing liquidity or supply and demand lower to see if they can profit by driving the price down. But if they are met with buyers, they start to sell their shares back to bullish buyers or switch into a bullish position. Let's move into another example that might help you visualize what PWT teaches and shows you. Imagine that a stock is like a spring. The tighter the supply and demand or liquidity gets, the more pulled back the spring becomes. When the spring becomes very pulled back, the stock is more likely to force itself in the opposite direction. This is exactly what happens with the 4 waves. If wave 3 was heavily shorted, causing the stock to drop back to a complete wave reset, wave 1, then you can expect a spring back to a higher price at some point in the future. This is barring any terrible news that the company releases. The likelihood of the stock at least retracing 50% toward its most recent highs is very likely based on what our data shows. This 50% retrace of the total drop into wave 1 normally is not realized in wave 1 because shorts still have a high leverage position. Let's go back to that example of a stock acting as a spring. If wave 1 goes and the stock only moves 5% of the 50%, the tension created by wave 1 has stretched the spring lower, causing the probability of wave 2 to release that 50% retrace toward where the stock was before the short attack and sellers caused that downtrend. The same story goes for any of the falling waves. As tension builds up, the more likely the stock is to retrace toward the previous highs, or even make new highs if the company has positive catalyst or has been having continued growth. Now that you know the basics of the 4 waves in parabolic wave theory, let's briefly talk about the phases of the waves. The phases of the waves are bullish, bearish, overextended, and convergence test. The bullish phase means that the market maker currently has been transitioning out of a short position and perceived value has shifted bullish. The bearish phase means that the market maker and sellers have more control over the stock, causing a higher probability of dropping in price. The overextended phase means that the stock is still in a bullish trend, but the stock has equal probability of dropping in price than in continuing up in price. That brings us to the last phase, which is convergence test. This is a point in the bullish cycle where there's a battle between shorts and longs trying to take control of the direction of the stock. The stock is more bullish on a convergence test than bearish. Sometimes market makers will test supply and demand of the stock to see if they should stay bullish or if they should turn bearish. This can cause manipulation, making the stock look like it's going to start going one direction, but in reality it will go the other direction in a few days. Thanks for tuning in to the Parabolic AI series and learning more about how our systems and research can be utilized.